Microfinance organizations, or MFOs, operate much like small banks that make loans to poor people. Borrowers use the money to deal with unforeseen expenses, finance household purchases, and start and grow small businesses, all of which help to disrupt cycles of poverty. What most people don't realize, however, is unlike banks, most MFOs can't accept deposits and thus have to rely on external funders to finance their lending activity.
Collectively, MFOs borrow about $30 billion per year, and most of this money comes from two types of funders that operate according to two different institutional logics. Commercial funders adhere to a financial logic. They raise private capital and invest in large, well-performing MFOs that can repay their loans with interest. Public funders adhere to a development logic. Money comes from governments and aid agencies and targets MFOs that are small, not yet self-sustaining, and engaging in high levels of social outreach.
Most agree that a nation's microfinance sector performs better when funders behave this way so that funding is available to MFOs of all sizes, and the development of up-and-coming MFOs is fostered. In our study, we find that, all else being equal, commercial funders lend to larger, better-performing MFOs, while public funders tend to lend to MFOs of all sizes and those with lower levels of performance.
However, lending to MFOs is complicated by the fact that many are in developing nations where there are varying levels of economic and political uncertainty. We suggest that funders will interpret uncertainty through the lens of their institutional logic and alter their behavior accordingly.
For commercial funders, the need for financial returns makes it rational to invest in large and stable MFOs. But because uncertainty casts doubt on the future effectiveness of past strategies, these funders pay less attention to MFOs' past financial performance when making loans.
For public funders, holding a development logic also motivates a move toward larger MFOs. Funders can't invest in development projects if they lose their money, and failed MFOs don't contribute to a nation's microfinance sector. Thus, when political or economic uncertainty in a country increases, both commercial and public funders invest in larger MFOs.
Theoretically, this means that though institutional logics may motivate different types of behavior in stable environments, their behavior converges when things become uncertain. The link between logics and practices is thus contextually contingent.
The practical implication of this is that as a nation becomes more uncertain and vulnerable people are more likely to fall into poverty, funding for small MFOs is constrained, creating operating challenges and likely leading to higher failure rates. At the same time, money clusters into a few large MFOs that on average do less outreach to very poor borrowers.
In this way, our paper suggests that it is important for governments, regulatory bodies, and public funders to acknowledge the role of uncertainty in microfinance funding and make provisions to ensure stability in a nation's microfinance sector, even as the broader environment is beset by uncertainty.